JBS completely missed the Q2 2026 EPS consensus today.
Yeah, they really did.
I mean, we're looking at a global meat processor posting record Q2 net sales like $23.9 billion.
Which is a massive 14% jump year over year.
Right, and it easily beat the $22.77 billion consensus. And this is the big issue-adjusted EPS came in at just 20 cents.
Yeah, missing that 34-cent forecast by, what, a 41% margin?
Exactly, a huge 41% miss. And unadjusted net income, that was an outright loss of $102 million.
Right. And looking forward, management slashed 2026 CapEx by $400 million, bringing it down to $2 billion.
They also targeted a working capital improvement of about $500 million, and they confirmed year-end net leverage is going to stay slightly above their 3.0x target.
Which is definitely concerning. As for the stock reaction, shares slid nearly 5.8% pre-earnings.
But then the regular session trading was surprisingly muted.
Right, hovering between like 13.11 and 13.40.
Yeah, keeping it in the lower half of its 52-week range.
So today, for this deep dive, we're pulling from BTG Pactual Analyst Notes, the Q2 earnings call, and the company's IFRS filings.
And the mission here is really to figure out how a multinational protein giant survives a brutal structural U.S. cattle shortage.
Right, while simultaneously, engineering its cash flow, expanding into Asia, and completely shuffling its C-suite.
Yeah. So if you're looking at these headline numbers, the immediate question you have to ask is why the market didn't just absolutely punish the stock during the regular session.
I mean, it's a valid question.
Right. A $102 million net statutory loss on record revenue implies some serious operational dysfunction. But the market basically just absorbed the hit.
Yeah, that really did.
It feels like investors are looking at a leaky pipe, but instead of panicking about the water on the floor, they're just impressed by the speed of the bucket catching the drips.
That's a great way to put it, because, the market looks straight past that headline statutory loss. Well, because it was dragged down by a very specific, heavy bucket of non-recurring items.
Yeah.
Like, if you break down that $102 million loss,
Yeah.
you find $172 million in premiums, interest, and costs tied directly to liability management.
Oh, wow. Okay.
Yeah, they were executing tender offers for their bonds in their CRA, which is a Brazilian local agribusiness debenture.
Right.
And then you have to stack on $133 million in antitrust settlements.
Which, I mean, let's be honest, those are basically just the cost of doing business in highly consolidated industries at this point.
Exactly. And finally, there was an $81 million non-cash charge related to the final bargain purchase calculation for their Mantiqueira Alimentos acquisition.
Okay, so when you strip all that noise out, what do you get?
You get an adjusted net income of $218 million.
Right. But honestly, even that adjusted earnings number isn't what kept the stock afloat.
No, not at all.
The market was hyper-focused on the cash flow pivot.
Yeah, the cash flow turnaround was wild. Last year in Q2, JBS burned $55 million in free cash flow. This quarter, they flipped that to a positive $130 million.
That is a massive $185 million turnaround in just 12 months.
It is.
But let's explore the mechanics of that turnaround, because it wasn't driven by selling more profitable beef.
No, it definitely wasn't.
They achieved that positive free cash flow by aggressively massaging their working capital. They leaned super heavily into receivable discounting.
Right, which basically means they took the IOUs from their customers and sold them to a third party for cash today.
Exactly, rather than waiting, 30 or 60 days to collect. And they also secured larger advance prepayments from Chinese customers importing from JBS Brazil.
Essentially pulling forward cash to patch the current quarter's liquidity.
Exactly. Which means I have to push back a bit on giving management a free pass here.
Okay, let's hear it.
I mean, it's clever financial engineering to show positive free cash flow, but you cannot pay down a 3.1x net leverage ratio with adjusted earnings or factored receivables.
That's a fair point.
Statutory losses still eat into the actual balance sheet. Their average debt term right now is sitting at 15.3 years at a 5.7% cost.
Right.
When your leverage is stuck above your 3x target, that debt load fundamentally handcuffs management regarding future aggressive organic expansion.
Well, I'll actually take the other side of that slightly.
Okay.
Because management isn't acting like they have a free pass. The $400 million CapEx cut you mentioned in the cold open.
Bringing the 2026 budget down to $2 billion, yeah.
Right. That is a direct admission that their hands are tied.
Yeah, that's true.
When a company of this scale slashes CapEx by that magnitude, it means they are actively delaying critical facility modernization.
They're pausing automation rollouts.
Exactly, putting the brakes on footprint expansion.
Yeah.
They are prioritizing balance sheet protection over growth because that 3.1x leverage absolutely restricts their agility.
Right.
And they are enforcing this working capital discipline precisely because their core operational engine, the U.S. business, is hemorrhaging cash.
Yeah, the margin compression in the U.S. is the anchor dragging down the whole ship right now.
Definitely.
If you view JBS as like a massive, globally diversified equity portfolio, you have these different asset classes performing in totally divergent ways.
Right.
So right now, the U.S. beef segment is the lagging legacy asset dragging the fund average down, while their emerging market exposure, specifically Brazil, is the high-yield alternative asset keeping the entire portfolio afloat.
The segment data illustrates that divergence perfectly, too. Look at the U.S. beef segment first. They posted record sales of $7.77 billion.
Which is huge.
The top line is incredibly robust, meaning consumer demand is still totally there.
Right.
But the margins are deeply negative.
Right.
They posted an adjusted EBITDA loss of $78 million under IFRS, which is the international accounting standard they report under. The biological reality of the U.S. cattle market is just brutal right now.
Yeah, we have incredibly tight cattle supplies.
We do.
And, when supply tightens, the cost of acquiring live cattle just skyrockets.
Right.
For those of you tracking the packing margins, the critical metric here is the spread between that live cattle cost and the cutout values.
And the cutout being the wholesale price JBS gets for the processed beef.
Exactly. Right now, the live cattle costs are completely outpacing any pricing power JBS has on the cutout side.
Which forces dramatic operational decisions. I mean, you don't shutter physical infrastructure if you think a cyclical turnaround is just, 3 months away.
Definitely not.
The supply constraints forced JBS to permanently close 2 facilities, a processing plant in Souderton, Pennsylvania, and a case-ready plant in Memphis, Tennessee.
Wow.
Yeah. They are actively trying to optimize their capacity utilization, basically shifting that stranded production to other, more efficient plants.
Excellent.
Furthermore, they restructured their entire U.S. corporate footprint. They took 3 distinct divisions.
Which were fed beef, regional beef, and case ready, right?
Exactly. And they consolidated them into a single unified unit called Beef USA.
Okay, yeah. That is textbook margin protection behavior. You strip out redundant overhead and streamline operations when the macro environment aggressively turns against your core business model.
Precisely.
So that's the bleeding in the U.S. But if you flip the coin to the Brazil boom, you really start to see why the multi-protein, multi-geography strategy exists in the first place.
Oh, absolutely. JBS Brazil posted its highest Q2 EBITDA on record.
Wait, really? On record?
Yeah. We're looking at $269 million with a 5.9% margin.
That's wild.
They are benefiting massively from export demand, particularly from China, which they are fulfilling while, capitalizing on favorable currency exchange dynamics.
Right. The currency helps a lot.
But they also have incredible domestic strengths in Brazil with their Free Boy barbecue portfolio.
So they're winning on both fronts there.
Exactly. Because cattle supplies in South America are in a much more favorable phase of their cycle, JBS is effectively balancing heavy volumes across both export and domestic channels to maximize the margin on every single animal processed.
And the diversification really paid off beyond just Brazilian beef, too.
Right.
JBS USA Pork saw its EBITDA margins expand to 8.9%, which is up from 6.5% a year ago.
Yeah, that's a solid jump.
Pilgrim's Pride and Sarah, which are their poultry and prepared foods divisions, remain solidly profitable, too.
Yeah.
Pilgrim's Pride faced a tough year-over-year comparison and an industry-wide U.S. chicken oversupply issue, but they still delivered strong margins. And Sarah maintained almost a 15% EBITDA margin.
So the cash flow generated by pork and poultry is essentially subsidizing the U.S. beef operations right now.
Basically, yeah.
But management knows they can't rely on accounting tricks and Brazilian exports forever. They need a tactical, physical fix for the U.S. supply shortage.
Which brings us to probably the most debated topic on the earnings call, the Mexican cattle catalyst.
Yes, Wesley Batista Filo emphasized this heavily.
Right. The U.S. border is gradually reopening for live cattle imports from Mexico, starting August 24th at the Douglas, Arizona port.
And that's going to be followed by expectations for Santa Teresa and Columbus in New Mexico.
Okay, so how does this historical flow normally look?
Historically, Mexican cattle accounted for about 5% of total U.S. slaughter volume. But because the border has been closed due to regulatory and health protocols, there is a massive backlog of cattle that have been backgrounded in Mexico.
And, for anyone unfamiliar with the term, backgrounding simply means these calves have been grazing on pasture, putting on preliminary weight while waiting for the border to open rather than moving straight into a feedlot.
Right. And because they've been backgrounded for so long, they are much heavier than the typical Mexican import cattle.
Got it.
Management expects this border reopening to inject roughly 1 million of these heavier head into the U.S. market.
1 million head. That's a lot.
It is. And because they're entering the U.S. at a higher starting weight, they require less time in the domestic feedlots before reaching slaughter weight. So, JBS management is projecting that this rapid influx of heavy cattle could restore historical trade flows and push U.S. beef margins back toward break-even by the second quarter of 2027.
Okay, I have to play devil's advocate here using the BTG Pactual Analyst Notes because this timeline feels aggressively optimistic.
It definitely is aggressive.
BTG pointed out that JBS is far more bullish on this border reopening than practically any of their peers. Like, are we sure management isn't viewing this purely through rose-colored glasses?
Right.
Scaling up to 1 million head requires seamless logistical execution across multiple border ports of entry, which are, notoriously prone to bottlenecks and geopolitical friction.
Look, management isn't completely delusional here because that backlog of 1 million cattle actually does exist on the Mexican side.
Okay, so the supply is there.
Yes, and the heavier weights do mathematically shorten the feedlot to slaughter timeline. However, the execution risk is massive. Relying on border logistics to solve a structural domestic supply issue is inherently fragile.
Inherently fragile, exactly. But the bigger issue is the underlying U.S. cattle cycle itself. We're talking about a multi-year herd rebuilding phase that hasn't even properly started yet.
Right.
The leading indicator for herd rebuilding is heifer retention. Ranchers have to hold back female cattle from slaughter so they can breed and produce the next generation of calves.
It's a biological bottleneck.
Exactly. It takes years for those retained heifers to breed, gestate, and for their calves to reach slaughter weight. And right now, U.S. heifer retention remains incredibly timid.
Why is that?
Because drought conditions and high input costs are just completely discouraging ranchers from expanding. So, is a one-time injection of 1 million Mexican cattle really enough to bridge a multi-year structural deficit in the domestic herd?
The short answer is no.
Right.
And that is exactly why the market reaction was muted rather than euphoric. The Mexican cattle represent a temporary bridge, a one-off injection of supply.
But if that bridge takes longer to build due to logistical friction at the Douglas or Sanitary supports, JBS's timeline for reaching break-even in U.S. beef by Q2 2027 will almost certainly slide.
Oh, without a doubt. Investors are pricing in that exact skepticism regarding the biological timeline of the U.S. herd.
So, if the Mexican cattle are just a tactical band-aid for the U.S. market, management has to be looking elsewhere for actual structural growth.
They absolutely are.
Which brings us to the strategic horizon. They are shifting aggressively toward Asia. While they're fighting margin compression in Pennsylvania, they just announced a massive $5 billion partnership with Indonesia's sovereign wealth fund, Danatara.
Yeah, JBS is taking a 25% active stake in this joint venture. And the strategic logic here is brilliant when you consider their current balance sheet constraints.
Tell me more about that.
They want to aggressively expand their footprint across Southeast Asia, right?
Right.
Gaining direct access to a market of 745 million consumers whose protein consumption is rising rapidly alongside their middle class.
And they plan to use their existing Australian and New Zealand operations as the supply hub for this new demand.
Exactly. But doing this through a well-capitalized joint venture with a sovereign wealth fund means JBS doesn't have to shoulder the entire capital burden themselves.
Oh, that's smart.
Right. It gives them massive geopolitical leverage and market access in Indonesia without immediately blowing out their own 3.1x net leverage ratio.
It's a strategic masterstroke on paper, but, you can't evaluate the future of JBS without looking at who will actually be steering the ship to execute all of this.
This is the big one.
Yeah, this is the governance news that really spooked the market right before the earnings dropped. Global CEO Gilberto Tomazoni is stepping down in January 2027.
Handing the reins to 34-year-old Wesley Batista Filho.
Right.
I mean, it is an orderly transition, but one that is highly scrutinized by institutional capital.
Naturally.
Batista Filho has a robust resume, though. Despite his age, he has a 15-year tenure at the company. He's led JBS Brazil, the broader South American operations, and he currently oversees the massive U.S. portfolio.
Okay, so he's been around.
Yeah, he knows the operational mechanics of the slaughterhouses and the supply chains intimately.
But handing the keys to a 34-year-old, even an experienced one, triggered immediate market anxiety.
Because it marks the return of a founding family member to the absolute top spot.
Exactly. JBS has a very complicated historical relationship with the market regarding the Batista family's controlling stake and past corporate governance issues.
Right. Tomazzoni was widely respected by institutional investors precisely because he wasn't a Batista.
Right, he is the outsider.
He was viewed as the stabilizing force who professionalized the management structure, instituted strict capital discipline, and drove their dual listing strategy to better align with U.S. capital markets.
So the 5.8% pre-market slide in the stock was largely a knee-jerk reaction to the perceived governance risk of a Batista returning to the global CEO chair.
Absolutely. The institutional community is going to watch Batista Filio like a hawk to ensure the capital discipline Tomazzoni instilled, like cutting capex when leverage gets too high, remains fully intact.
And that capital discipline debate brings us squarely back to the current valuation of the stock. We have massive operational headwinds in the U.S., a delicate transition in the C-suite, and a balance sheet requiring heavy working capital management.
But when you look at the trading multiples, JBS looks incredibly cheap.
Right. According to Investing Pro, JBS is sitting on their most undervalued list.
The company trades at a rock-bottom EBITDA multiple of 6.24.
Wow, 6.24.
Yeah. For a company that just generated nearly $24 billion in quarterly revenue, holds prime, irreplaceable processing assets across multiple continents, and has a dominant global market share in multiple proteins.
That is a steep discount to its intrinsic fair value.
It really is. The market cap is hovering around $14.36 billion. The market is heavily discounting their future earnings power because everyone is terrified of the duration of the U.S. cattle cycle.
So if you're an investor looking at this setup, you see the clear cyclical fractures in the U.S. beef segment, but you also see the incredibly robust cash flow pumping out of Brazil, the pork division, and the poultry assets. You see the prescribed treatment plan, a heavy dose of Mexican cattle imports, severe operational consolidation, and $400 million in capex cuts.
The core thesis for buying the stock here is that you're getting paid to wait.
Exactly.
You buy it at a 6.24 multiple, collect the diversified cash flows from outside the U.S., and just wait for the U.S. cattle cycle to inevitably turn,
Right.
at which point the earnings leverage will be massive.
But let me leave you with a final thought to ponder that goes beyond the standard cyclical analysis.
Okay, lay on us.
Everyone assumes the U.S. cattle cycle will eventually rebuild, just like it always has. But what if the structural realities of climate-induced water scarcity and permanent degradation of grazing lands in the American West mean the cost of feed and backgrounding will never return to historical baselines?
That's a scary thought.
Right. What if the domestic herd size is permanently capped at a lower level because the land simply cannot support massive expansion anymore? If the historical cattle cycle is actually broken, JBS might not be a brilliant, deep value play for patient capital. It might be a classic value trap waiting on a biological rebuild in Mexican supply lines that will never fully materialize, all while that 3.1x leverage slowly strangles their ability to adapt.
If the underlying geography of American agriculture is permanently shifting, the historical EV/EBITDA models simply won't save you.
Exactly.
And navigating that structural reality will be the defining challenge of Wesley Batista Fido's tenure.
A massive test for a 34-year-old CEO. Be sure to follow the show for daily earnings coverage.